The last time interest rates were this high, this is what the economy looked like. First, let's give a little context for how high interest rates are and when we might be going back to in the past, because it's been a while. You have here the last few years in the 10-year interest rate, which is really the benchmark for U.S. interest rates here from the U.S. Treasury. Similar to you read a story or hear about something on the radio or news about the stock market. Oftentimes it's the S&P or the Dow Jones or the NASDAQ. The 10-year, really one of those big benchmarks. And you can see here, 10-year above 4.5%. The highest that it's been for the last few years here. And also just the sheer magnitude of this move. You go back to early 2020, and before the pandemic, the Fed was just starting to hike interest rates again. Interest rates were just starting to get off of 0%, where they had been really from the financial crisis until about 2018. And we'll show you that data in just a second. And then the pandemic hits, interest rates go down to essentially 0% again. The Fed and central banks globally are afraid of an economic slowdown. And so they bring interest rates lower to help out with this pandemic fear that is entering and its potential problems. Now, since then, my friends, you look at this chart, since the mid part of 2020, even pretty much the start of 2021, over the course of the last couple of years, the 10-year has gone from 50 to 100 basis points to above 450 basis points worth of yield. Huge move. I mean, more than fourfold higher here. Essentially, if this was a stock over the course of the last couple of years, you might call it a meme stock because of how much it's moved from 1% to 4%. That's, a tripling, quadrupling effect here over the course of just a couple of years. So huge move, and also moves us into territory that we have not seen since 2007, and has me wondering, because you go back to 2007, and it's not a case of like we're at 4.5%, and in 2007 we barely touched 4.5%, and then we came lower. No, back in the 04 to 07 range, 10-year rates were consistently above 4%, went up to 5%, were higher than where they are now, and stayed there for a few years. Like I say, between 04 and 07, look at this time frame, we were there. And then, of course, prior to 04, prior to especially the dot-com bubble bursting in 2001, 10-year rates were as high as 6, 7, 8%. So we've been here before. This is an extreme when you talk about the last decade plus, but we've been there before. We've also been in this range. We can be here 4 years at a time. It doesn't necessarily have to be a price extreme and then come lower. And it's just a matter of, will it be 4.5% or 5% or 6% before it reverts lower? We can stay up here for a good amount of time. And so I wanted to look at a couple of things to gauge what the economy might look like going forward. And of course, the economy can take whatever shape or size, but we're going to look at this time frame and see what was going on, similar to what we're seeing now. Not to as great an extent as we have seen over the course of the last 12 months, but there was high inflation in this 04 to 07 stretch. Now, the central bank here in the U.S. and most central banks abroad tend to look for 2% inflation. Now, this 2% tells them, one, our economy is moving in the right direction, because if we were seeing deflation, prices for goods and services were moving in the negative direction, that would tell you that your economy is not growing, it's contracting. And so they want to see some inflation just to show that businesses and also consumers are getting more money in and able to spend that money at just that 2% increasing annual rate. Now, when it gets higher than that 2%, that's when the Fed their alarms are springed, and they start to look at hiking interest rates. And so you can see why 10-year interest rates were so high as 4.5%, 5%, even higher during that 04 to 07 stretch. Inflation was pretty consistently above that 2% target and got up to even 5% and beyond. Didn't see the heights that we saw last year, but got pretty high. And like I say, was consistently high for this 3-year stretch, similar to how we've been over the course of the last year or two. So similar inflationary environment. Now, looking at the stock market environment of the time, remember, at the time, we were still in recovery mode from the dot-com bubble. But in that 04 to 07 stretch, the S&P actually averaged about 7% gains per year, was up every year in that stretch from the start of the year to the end of the year, and was up a total of 32% in that span. Again, does that mean that from last year until 3 years from now, as 10-year rates have gotten close to and beyond 4%, that the S&P is going to be up 32% exactly? Absolutely not. Does the S&P have to be up at all in the next 4-year span? No, but it at least tells you that interest rates being higher doesn't necessitate that the stock market has to contract and underperform and perform negatively. We've seen a sustainable environment of high interest rates and upside in the stock market, which is meaningful to me, even if you can't necessarily say, okay, well, if the S&P in a given year is up 10%, then I'm going to sell it until it's up only 7%. And if it's up only 2% or 3%, I'm going to buy it until it's up 7%. It's not what we're saying here, but showing you that there is, potential for stock market gains and interest rates moving higher. Another piece that I thought was interesting, and this is one similar to that, interest rates being higher is bad for the stock market, kind of cliche or whatever you want to call it, is interest rates being higher, bad for home prices. But this is one when you go to try to myth bust it, like we did a little bit with that S&P just now, there is some reasoning behind this historical price action that does not necessarily confirm it, but does align with this thinking. You go back to the 04 to 07 range. And in this chart of U.S. family home prices, from the National Association of Realtors, this was one of the only periods that home prices were about flat. And then obviously in the financial crisis, you see that was one of the only points when home prices moved lower year over year. Since then, since about 08, 09, it's been a pretty consistent up and to the right graph. And before then, even amid the dot-com boom, you see prices moving higher every year. So there is maybe a case for high interest rates, home prices not moving much higher. I mean, they're not collapsing in this period, but it is pretty much flat action, and some of the only flat action or slow growth, relatively speaking, over the course of the last 25 years. Here's the last piece of just, what this all could mean. Is, of course, like I said, the numbers don't have to exactly line up. We're just showing you here today that the last time rates were this high, this is what it looked like, and this is what can happen. You also might notice, Frank, you talked about 04 to 07. What happened to 07 and 08? Well, there was obviously the financial crisis of that time and the coinciding stock market crash, S&P getting cut in half over that period from high to low. And it's not necessarily that high rates caused the crash or caused the financial crisis, caused the bad dealings that were done before it all came to light, but it does cause potential turbulence. We've seen volatility on average be higher the last couple of years here than when interest rates were low throughout, 2010 to 2018 there. And it's because it can bring potential bad dealings or bad, economic policy to light. When interest rates rise, it contracts the economy, but it also kind of puts a spotlight on companies or governments or whoever whose books maybe look out of line. It puts some stress on them, so to speak. So it doesn't necessitate a crash. We've seen, like I say, high interest rates and stock upside, but it can create some turbulence. It can put spotlight on potential sectors, like we've seen with the regional bank crisis earlier this year, that maybe aren't up to snuff, so to speak. So we'll see what happens this time around with this new high interest rate environment. There you have it, the most recent one back in 04 to 07.